Today's August 23rd, 2015, and I wanted to get this video out showing some of what's happening around the world and the world's markets. And this is important to you because the financial crisis that began back in 2007, 2008, which affected pretty much everyone in the industrialized world, was not allowed to play out. Governments, institutions, banks stepped in to stop the restructuring, the reappropriation of capital and resources around the world, mainly because they would have been out of power. They would have been out of the money centers of the world. And so the problems that actually created the crisis have only increased in size since then. The too big to fail banks have become even larger, a larger part of the economy, a larger percentage of the economy. The financial industry has become a larger percentage of the economy. Debt has increased across the world. Central banks' balance sheets have increased substantially. Money supply has been expanded substantially as well. So when the future crisis comes, because of the debt that was there from the 2007-2008 crisis, and then the increased portion from 2007 until now, it's going to be worse, that much worse. And if you're not prepared for it, then it will damage you financially. It will damage you probably physically, what you're going to be able to do, what you're going to be able to, where you're going to be able to live, what you're going to be able to buy, where you're going to be able to travel to and from. We also know that manipulation doesn't work in the long term. And the mathematics behind the economy and the foundation of the economy, which is fractional reserve banking and continued debt and credit expansion, will not work indefinitely. All right, so let's get right into it. This is the US dollar index chart, and this is a pretty long-term chart from the end of 2005 all the way to 2015. And as I mentioned in last month's video, a lot of the strength in the US dollar has been related to the talk by the Fed that they're going to begin raising interest rates in the United States, which they brought down during the financial crisis. And this has put pressure on all sorts of other cross currencies and commodities. But as this Business Insider article says, in just 1 week, everything has changed. I'm going to read a little bit of this. All it took was a few days. At the beginning of the week, it seemed the Federal Reserve had all the confirmation it needed. The economy was ready for tighter monetary policy. Markets had been taking the economic data releases in stride in this final stretch before the meeting on September 17th, and the Fed futures reflected that markets were betting on a 50% chance that the Federal Reserve would raise interest rates at its September meeting. We crossed a major hurdle earlier this month with a satisfactory July employment report, which, by the way, they used the birth-death model to add unemployed figures to that. And of course, we know that there are many thousands of people who are not on the report just because they haven't been working for so long that they just take them off the report. Anyway, retail sales for July showed that consumer spending is more robust today following a weak first quarter. This week, several retail giants, including Target, Lowe's, TJX, reported an increase in same-store sales. U.S. monetary policy was seen as headed toward tightening, means raising interest rates, while central banks elsewhere kept a tight lid on interest rates to support their economies, like Japan. There had been concerns that lower energy prices would do more to keep inflation at bay, because they have like a 2% target that they're trying to get. So they're worried that it may decrease the inflation rate and further off the Fed's 2% target. There you go. And that there was still considerable slack in the labor market coupled with slow wage growth. Yet a September rate hike looked plausible to many economists on Wall Street. But that changed in a few days. And this is with the release of the FOMC July meeting minutes. And so the expectation of a rate hike in September decreased dramatically over the last couple days. Anyway, I'll put a link to this article if you want to go into more detail about it. But this has sent the US dollar index lower because, as I said, so many cross currencies were being sold, and people were buying the dollar. And then, of course, there was the U.S. carry trade, basically, that was going on, and the unwinding of about $10 trillion of corporate and private debt that was issued in the US dollar currency that basically was like a margin call that as it continually increased, it became expensive to hold that, and people were being forced out of those positions, which is probably where it peaked back up here at nearly 100. Anyway, the Federal Reserve has been playing chicken with the market as far as raising rates. The quantitative easing programs 1, 2, and 3, and zero interest rate policy, which is what they did by bringing the rates down in the crisis, has been what has supported the markets around the world, and the U.S. stock market and the U.S. real estate market, and probably a number of other markets as well. So taking away the quantitative easing has made it so that the stock market hasn't really been able to go much farther higher. To also take away the zero interest rate policy and start raising rates will take away that support from the market. And so they've wanted to have their cake and eat it too. They've been trying to walk this fine line of saying, we may raise rates, we will raise rates at some point in the future, but when we do, they're going to be very slow, and if we do it, it's going to be very data dependent, and we can't tell you when, and giving all of this quote unquote forward guidance, which is basically just propaganda to get people to do things and act certain ways. But the threat of raising rates has caused the US dollar to go up, which has made other currencies go down, and commodities including gold and silver. Now, a strong dollar is good for the US consumer. It makes imports cheap, and most things are imported into the United States for the consumer. And it also makes it so that exporting countries like Japan, China, Korea, Brazil, India, all these other countries can export their products profitably to the United States. And of course, another part of what I want to show here is that these exporting countries are competing for that market share by depreciating their currencies, which is what we've seen in China. But anyway, the Fed is between a rock and a hard place, because they've been saying for so long that they're going to raise rates and that they probably will. And then they even gave a date, which was September. And they got all this hype for it. But in reality, I don't think they can ever really raise rates. If they do anything, it's going to be very, very small. And it's going to be over a very long term, because of the debt load that's being carried by the government and by corporations and by individuals. And they don't want to put a headwind for the stock market and for the real estate markets. Anyway, so let's move on to what's happened in the currency markets in some of the other countries. Now, here is the Chinese yuan chart against the US dollar. And you can see here that it took a massive move down. They have allowed the yuan to trade within a range, but pretty much been pegged to the US dollar, which, as the US dollar has increased, it's actually increased the yuan as well, making their exports more expensive relative to their other competitors like Japan and Korea. And I think this also has something to do with the IMF SDR decision to keep the basket of currencies, to keep the voting power the way it is for another year at least. You can see here that on this timeline that the IMF proposes to keep the SDR basket extension, and then China went, I think China was like, okay, they're not going to allow us to take the position that our economy should have and give us the voting power that we should have, and so they allowed, and so they devalued their currency, which makes them more competitive. And as you can see, the Chinese have allowed their currency to appreciate quite greatly since 2005. And but they've devalued it here. But I'm going to show you this chart, which shows you that compared to other exporting nations whose currencies free float on the Forex exchange market, the Chinese actually have quite a ways to go. They pegged their currency to the US dollar, so you see it's risen in tandem with the US dollar. whereas other currencies have fallen. So as it's increased in value, they lost a lot of market share. And I think with the decision by the IMF to not include them in the SDR basket and give them more voting power, the Chinese have thrown in the towel and said, okay, well, we're going to devalue and take back some of our market share from the rest of the exporting nations. Nations that have engaged in their own quantitative easing, their own devaluation to increase their market share around the world, like the Japanese, for example. Here you can see the Japanese yen. I made a video back last year talking about the Bank of Japan and their decision to devalue the yen to try to stimulate the export side of the economy and to devalue and create inflation, which has taken made a lot of Japanese companies profitable, but has taken a lot of market share from the rest of the Asian countries as well. This has actually sparked fears that there may be another round of Asian currency devaluations, which could trigger another financial crisis in Asia like it did back in the 1990s. And you can see this quite clearly in some of the US dollar cross rates. This is the Japanese yen, which has increased in buying power against the US dollar substantially over the last couple of days since the release of the FOMC meeting minutes, as well as the euro. You can see here it's up quite strongly as well. And this is also being shown in the price of the gold and silver, which has moved above the July 21st smash, which my last video was about, which is great. And it still hasn't really broken out of its downtrend, which I've shown in other videos, so I'm not going to really go over that right here. It hasn't really broken out in both metals substantially, but this could be the point at which it does. And if it does, we will begin a new bull market in the gold and silver markets, which will probably take us to new highs. What I think, as I said, the Federal Reserve is between a rock and a hard place. Do they raise rates and take the wind out of the sails of the stock market, the real estate market, and the bond market, and then come in with QE4? Or do they blame the weak economy on China or some other geopolitical event, and then they come in with QE4? What we do know is that the mathematics behind it, they actually have to keep adding more money and forcing more debt, more credit into the system for it to be able to continue. It's just the way it works. So is it now that they come out with QE4, or is it going to be later after a rate increase and a deflationary crash in the markets? Honestly, I don't know. But the gold and silver price are at a very important juncture, and I think the decision-making power is actually going to be taken out of the Fed's hands quite soon. And it could be because of the physical metal shortage that is developing in the precious metals markets. Another interesting thing is that the People's Bank of China came out with an additional update on their gold holdings from June. They added another 19 tons to their reserves. And this is probably to give increased confidence in the yuan, which they will probably do as they continue to allow it to devalue, or they devalue it themselves. From a technical side, gold and silver have put in what looks to be some major lows, and these should act as support on any decreases in price and will be dips to be bought. Again, as I said, we still haven't completely broken out of this multi-year downtrend that the gold and silver markets have been in. But if they do take out some of these higher price points and take out those trend lines, then we probably will be, from a technical point of view, inside of a new uptrending market. As you can see from this chart, gold has broken above its 50-day moving average, which is a very positive sign. There's some other quick charts I want to show you here. This is the New York Stock Exchange margin debt, which is at an all-time high. You can see that in the past, this is the dot-com bubble of the 2000s, and then this is pre-crisis 2007-2008 Lehman shock. We're well above these highs, Now, it could go a little bit higher, but it looks to me like we're putting in a high of the margin debt. And people who buy stock on margin, they're very, very sensitive to losses. They can't really sustain losses. They can't hold them in their portfolio. They have to get rid of those positions. And that feeds on itself, just like it fed on itself buying up, which is one of the reasons why I think we're going to see either the Fed come out and actually throw the market a bone and say we're going to delay QE to just keep this going. Otherwise, this could actually implode quite quickly, which is what happened in China. You can see here, this is their margin lending in the last year and a half or so. They had like, at this, I remember reading in the news, they had like 1 million new brokerage accounts opening over a very short period of time right around here, where people were just coming in and just borrowing money to buy stocks. But that has imploded, and this is probably one of the reasons why China is allowing a devaluation to offset some of this and to rebalance this and to get this kind of excess lending speculation in the market out of the market. Like I said, a physical shortage that seems to be developing. A lot of silver is being taken out of the COMEX, and the wholesale supply is quite tight. And retail side, the premiums have increased across the board on many products. Some products are no longer available. So we'll have to see how this develops, but I would suggest that you be a day early instead of a day late and have some of your wealth stored outside of the fiat currency system, because when it comes down to it, people are going to be asking the question, what is a dollar? What is a euro? What is a yen? What is a yuan? These are all arbitrary, elusive stores of value. There's nothing tangible behind it. And all of these markets are converging into the physical precious metals markets. All of these currencies, when they sell yuan to buy gold, they're all coming to that one central physical market to take it away. And here's the last chart I want to leave you with. It's the US dollar price of gold and the Russian ruble price of gold. This is what gold does in a crisis. You want to own some, you need to own some. It will maintain and maybe even increase your purchasing power. And I expect we will see this kind of action in the US dollar price in the near future. Anyway, I hope you get yours, and I'll follow this up with some articles and links that you can go ahead and do your own research and diligence and hopefully make some good choices. All right, take care.